I'm Tor from Pro Stock Tips, and in this episode I'll be explaining a strategy for gold investors that are based in the US. So currently you'll notice that the price of gold is $18.50 or thereabouts US dollars per ounce, which is quite high relative to historical gold prices. Now in Australia, the gold price is 2,568 Australian dollars, which looks quite impressive on this chart. It's not that far off from the all-time highs. And you'll notice that the US dollar is very strong at the moment. So this is resulting in a favorable exchange rate with the US dollar for gold producers. So the low-cost gold producers in Australia are benefiting not only from the high gold price, but also from the strength in the US dollar relative to the Australian dollar. So potentially their margins are significantly increased at the moment. So Australian gold producers, the low-cost ones that is, should have favourable profit margins at the present time, potentially relative to US producers. So therefore, there might be some advantage in investing in Australian gold producers. Now, on the other hand, if the US dollar does weaken over time relative to the Australian dollar, then potentially that could also be a tailwind for the price of gold. So it might help benefit the price of gold or support it. It's not the determining factor. Over the long term, the strength of the US dollar probably doesn't correlate that well with the price of gold. Whereas on the short term, obviously traders are looking at this, and it obviously does have an impact. However, if the US dollar does weaken over time, so that could have a tailwind effect on gold prices, as well as when it comes to time to take profit on this strategy, then you will convert your Australian dollars back into US dollars at a favourable exchange rate relative to your initial currency exchange. So there might be some forex advantage there as well. Albeit not the most significant part of the trade. However, all aspects counted for, right? So now, before you jump into any gold investment, I think that you should obviously have a forecast on the price of gold, which you trust at least to some extent. So obviously, if the price of gold is going to drop down to, say, $1,300 an ounce, you're probably not even going to want to be investing in gold at all, essentially. However, if you believe that the price of gold is going to remain stable or go higher, then certainly you would be considering investing in gold, right? I personally prefer copper as my investment theme. However, I do like to cover all commodities. So gold is a particularly followed commodity for resource investors, and there's many forecasts out there for the price of gold. A lot of them are conflicting. However, the one that comes to attention recently is the Commonwealth Bank of Australia, which has forecast a pretty stable price of gold of around $1,900 US dollars per ounce out till 2025. So let's say that the Commonwealth Bank is accurate with this forecast, then that's going to be, very favourable for Australian gold producers. They should make significant profits at this price, and they are probably undervalued. As you can see, the gold index, is down at the moment. However, if we were to price gold miners based on the $1,900 an ounce gold price, then they probably should be trading a lot higher. So that's where this strategy comes into play. So if you believe that the gold price is going to remain stable or go higher, then consider this as a investment strategy. Now, there's 3 gold producers in Australia, or gold producers or developers in Australia, that I'm going to cover in this video. Now, the first one, funnily enough, is not actually mining in Australia. You do still get that potential advantage of the I guess, strong US dollar, strong gold price, etc. Now, this one is still ASX listed, so ASX ticker X64. So this company's called 1064. Changed its name from Medusa Mining to X64. 1064, which is more relevant because that is the melting point of gold. So that's a more cool name. Definitely don't invest based on name. However, let's get into the fundamentals of the company. So it has a market capitalization of $167 million at around 75 cents, right? Now, these guys are well funded. So they have a lot of that market capitalization, is backed by cash, essentially. They have cash and bullion reserves of around US $76 million in value, essentially, which is around 100 to 110 million Australian dollars. They've quoted 46 cents per share. That's what they quoted. That's equivalent to 46 cents per share. So essentially, most of the market capitalization is supported by cash, which means there's probably less downside risk. Now, these guys are essentially performing a buyback as early as 13th of June. So essentially, buybacks reduce the number of outstanding shares, so the value per share should go up, right? So this should help support the prices or potentially bring them up. Maybe it can jump up to 90 cents. Certainly if they declare another dividend, they've had a good dividend yield lately, somewhere around 9 to 10%, I think it was. So that's quite a good gold stock, because you got the buybacks, the high dividend, the supporting cash balance. You've got plenty of reserves and development and exploration opportunities with this particular stock. So they are currently, mining at a all-in sustaining cost. Let me refer back to my notes. Here we are. Their guidance for this year, and I suppose you could base some of the future guidance for, say, 2023, based on 90,000 ounces at $1,350 to $1,400 per ounce. So that's still quite lower than the the gold price. So they still have that safety margin in terms of profitability. They got quite a good margin there, and essentially this could equate to around $50 million Australian dollars of EBITDA per year, essentially, based on my calculation, somewhere around there. So this company is well supported by its cash balance and its earnings. They have 330 kilo ounces of gold in reserve at a grade of 5.5 grams per ton. So that's very good. They still got lots of reserves here. And the thing that you'll notice about this company is it keeps replenishing its reserves over time. And they probably will continue to do that. So should the gold prices remain high, they're going to continue to generate a lot of profit for the next few years, in which case they're substantially undervalued at the moment, and they are returning capital back to shareholders through dividends and buybacks. They are currently working on the Tiger Way decline, which is to access ore deeper in the deposit. Not all of that ore has been explored, but as you can see from this chart, this diagram, it shows the green is the resource, whereas red is the reserves. Obviously, there's a lot of resource that could potentially be converted to reserves, and once the Tiger Way decline reaches the lower levels, they can mine that lower levels and also potentially drill deeper. It looks like this deposit geologically shouldn't be constrained by geology. It's probably more just a matter of constrained by the current drill depth, right? So as they extend this decline, they can drill deeper, and it looks like this ore body's consistently plunging, and essentially they should be able to add a lot more ounces. to the resource and reserves over time. So it should still be quite a long mine life left, as they continue to go deeper and replenish their reserves. Now, this decline is going to take up to quarter three 2024, so almost pretty much 2 years before they actually complete this project, and it has a total cost of US $54 million, which should be pretty much funded by the cash flow from their operations. They've already spent $13.5 million on this decline. So essentially, good cash flow from this company, probably very undervalued, significantly undervalued, if you were to use a stable or 1900 US dollars per ounce gold price, right? Now let's move on to an actual Australian producer. So Westgold, ticker WGX. So currently they have a $653 million market cap at $1.40. They have a cash balance of $189 million. They also have, so that's significant, right? So the whole part of this strategy is I'm not trying to recommend risky stocks. I want to recommend some safe, relatively safe stocks, right? That are well funded, for example. And, so obviously their cash balance makes up a significant portion of their market capitalization. They also have, don't know what I've written down here. I think it's 190,000 ounces of hedged gold at Australian 238. No, 238 wouldn't be very good, but $2,381 per ounce. Is very good, right? So obviously they can produce gold a lot cheaper than that. So this should, I haven't wrote down how much value that is, but I think from quick maths, it could be around like $100 million. So that's pretty good, right? So if they have $100 million, or should I say $100 million worth of profit margin in their hedged gold, that adds significantly to the, I guess, the safety net of the cash balance. So there's a lot of safety built into this stock, I think. And they do plan, however, to spend that money, but they're spending that money on expansion, right? So they're targeting 400,000 ounces at a gold price of Australian $1,600, right, by 2024. So let's say if your forecast was that the gold price is going to remain stable or slightly higher, then that's around $360 million of EBITDA per annum, which obviously relative to their $653 million market cap, is a very low PE ratio. So potentially, there could certainly be some advantage. It could certainly be very undervalued. Essentially, if you were to wait till 2024, so if your time horizon with these particular companies is 2 years or so, you could be looking at a very substantial return if you were to price the company based on a $360 million per annum EBITDA, right? The market capitalization should be at least $1 billion, I would expect. Now, currently they're producing 270,000 ounces at around the upper end of their guidance, so like $1,700 US dollars per ounce. 1,700 Australian dollars per ounce cost, which is around $1,260 US dollars per ounce. So there's still significant margin there between the current gold prices and what it's actually costing them, their all-in sustaining cost, I think that is, to produce the gold. So it is a bit hard to understand the current valuation of this company. I think it is certainly being valued at a much lower gold price. Potentially it's being valued at a forward gold price of around $1,500 per ounce, or less. And the third stock that I'd like to cover is Meteoric Resources, ASX ticker MEI. Now, the reason why I'm talking about these guys, given that they are not an existing gold producer, is that they've recently received a buyout offer for their Brazilian gold assets. And there's substantial value here because they're basically receiving a buyout offer in terms of Australian dollars is around $30 million, over the next 12 months or so from the completion of the sale, relative to their market capitalization of approximately 26 million at 17 cents, which they're currently trading at. So they're trading at a lower value than the funds that they should receive in the future. So there's a substantial safety net there with this stock. So the share price should be supported by that buyout deal, should everything go smoothly, right? So essentially, I think over the next year, you could see the share price trending upwards, as they start to receive these tranches of payments, that are very substantial relative to their market capitalization. So I think they could go from this 17 cents, all the way back up to 60 cents perhaps. Might be a good initial target, essentially not only will they receive a lot of cash relative to their market capitalization, but that doesn't price in their existing gold resource in Australia, which is the Palm Springs gold project, which has at least a minimum of a JORC resource of 357 kilo ounces at 2 grams per ton, a lot of which is in an open pit, is shallow enough for being exploited by an open pit, which is obviously a very cheap way to mine the gold. So that could potentially be a very economic gold project, which they may be well capitalized or well funded to potentially develop from the sale of their Brazilian assets. So I think that, surely it's not going to just hit at a share price reflective of the buyout offer. You would hope at least that investors are going to both price in that their cash balance, as well as assign some value to the Palm Springs deposit with its 357 kilo ounces, that it could potentially develop, given that it is now, or it should be, well funded to do so. Essentially they may need more capital expenditure. However, their position should be much stronger, given their funding. They should be able to potentially finance this project if the gold prices remain strong, in which case, that's where the share price could be 3 times higher, should they receive all this cash, and potentially, if their scoping study for this project, which is due to be released in the near future, shows favourable economics to the project in terms of low capex and high NPV, so net present value. So certainly keep an eye on that feasibility study. I think that the share price did jump from 14 cents to 19 cents, and then it has come back down to around 17 cents. Obviously investors, once the share price jumps like that, often it does come down as investors take profit, but then new investors or existing investors may want to buy more shares, which could drive the price back up, as investors realize the value proposition here. Now, another stock that I'd like to make a mention to is Nova Minerals, which is exploring for gold in Alaska. It also has a lithium asset, and last year you will potentially remember that they hit an impressive, a very impressive gold intercept. So there's a phenomenal discovery potential out there at RPM, which is where they're going to be drilling. So this is a very promising explorer, which, if the gold price is going to remain at these levels, should be very economic to mine this deposit. So they're potentially very undervalued and have a lot of exploration and development upside. So I certainly would give that a look. I'm not going to cover that stock too much in this video, as essentially I've covered that in other videos, and we'll hopefully be making a new video on NVA in the future. So keep an eye out for that. Now, thanks for watching, and good luck with your investment if you choose to have a look at this strategy. And essentially, for me, I certainly am investing in all of these stocks to various extents. However, a lot of my investment portfolio is currently focusing more towards, say, copper and lithium, for example, than, say, gold. Although I do have quite a high exposure to gold still. So other than these gold stocks, there might potentially be even better stocks to invest in. For example, I've made a video about Minerals Resources, which you should certainly check out. This is a copper, essentially a copper developer. However, they do have an option agreement with Oz Minerals, which is a major copper producer in Australia, that has an option agreement to potentially buy out Havilar's Kalkaroo copper project for potentially $270 million versus their $80 to $90 million market capitalization. So I certainly believe that could potentially be a very strong investment option. And there are many other investment options out there. So certainly these three stocks may not be these three gold stocks may not necessarily be the best performing options out there. So certainly go where you believe that the best investment opportunities lie, to suit your investment strategy. So thanks for watching, guys, and good luck.